Welcome back to Inventing Talk Podcast. Today, we're focusing on Joby Aviation, a really interesting player in the electric vertical takeoff and landing, or EVO, space. You sent us a bunch of information on Joby, including recent news and their financial reports, and our goal is to pull out the most important stuff for you.
We've got information covering everything from, what the company actually does and how they've been performing recently to their financial health, where they stand against competitors, and what the future might hold.
We also looked at a recent detailed analysis and updates on things like new partnerships and investments.
That's right.
So we're going to unpack what Joby Aviation is all about, what the latest numbers suggest, and maybe what you should really be paying attention to as you follow this company. So let's jump right in.
Okay.
What's the core idea behind Joby? What are they trying to achieve?
In essence, Joby Aviation, they're based in California, and they're in the business of designing and building these electric aircraft that can take off and land vertically. Their whole plan revolves around creating a sustainable air travel option, specifically for cities. Think of it like a ride-hailing service, but up in the air.
Okay, so instead of calling for a car, you might be able to book one of these electric aircraft. What's the big picture vision for how this would actually work day to day?
Well, the aim is for short trips. Their electric air taxi, it's designed to travel up to 100 miles, they say, and at speeds of around 200 mile-per-hour.
Wow, okay.
So the big idea is really to transform urban transportation, make it faster, quieter, and more eco-friendly aerial ride-sharing, basically.
That sounds like a pretty massive undertaking. Are they tackling this all on their own, or do they have some, major players involved?
No, they've definitely established some really significant partnerships. Toyota is a key collaborator.
Right.
And they're also working with Delta Airlines and Uber. These kinds of partnerships, they likely bring not just financial backing, but also really valuable expertise and potential paths for actually getting their service off the ground.
And it sounds like they're making headway on the regulatory side, too. The information mentions their work with the FAA.
That's absolutely critical. According to reports from early 2025, they've made notable advancements in navigating the FAA's certification processes.
That's huge.
It is. It's obviously a must-have before they can even think about starting commercial flights.
Let's shift gears a bit to how the market's been reacting to all this. What have we seen in terms of their stock price? The notes mention it hasn't exactly been a smooth ride.
That's right. Their stock has definitely seen its share of ups and downs, which honestly isn't uncommon for companies in these new potentially high reward but also high risk sectors like eVTOL.
Makes sense.
Over the 6 months leading up to February 12, 2025, the stock price seems to have generally hovered around $7.83, but with some pretty significant swings in there.
Volatility is the name of the game then.
Looking at the data you sent, the volatility seems particularly linked to announcements around FAA progress. Like, there was a noticeable jump in mid-January 25 that lined up with news of a successful wind tunnel test.
Okay.
So it suggests the market really weighs those technical and regulatory milestones heavily.
And if we look back further, maybe over the past year, what kind of overall trends jump out?
Well, the year-over-year trends really just reinforce that picture of substantial fluctuations we just talked about.
Right.
These movements often seem to coincide with important company news, think operational milestones, regulatory updates, but they're also influenced by the broader economic climate and, interestingly, even some of the dynamics we see with meme stocks.
Always a factor these days, isn't it?
Seems so.
Let's dig into the financial side now. What did their most recent earnings report for Q4 2024 and the full year tell us?
The revenue numbers. Well, they paint a somewhat complex picture. In Q4 24, revenue from their flight services was only $55,000.
$55,000. Wow, okay.
Which is a considerable drop from the $1 million they reported in Q4 of 2023.
$1 million down to $55K.
And looking at the entire year ending December 31st, 2024, total revenue came in at $136,000. Again, a significant decrease from the $1.03 million the previous year.
What could be behind that drop? Is it just focusing on development?
That significant drop in flight services revenue, it might indicate a shift in their immediate strategy, perhaps focusing more on development and certification rather than early revenue generation. Or it could point to delays in their anticipated operational timelines. It's definitely something worth digging deeper into in their full reports.
Got it. So a noticeable decrease in revenue. What about their profitability? Are they getting any closer to turning a profit?
Well, no. The net loss for Q4 2024 was approximately $246 million.
Oof.
which
Yeah.
is a substantial increase from the net loss of around $115 million in Q4 2023.
So the loss widened quite a bit.
It did, and for the full year 2024, their earnings per share, or EPS, which gives us an idea of profitability per share, was negative $0.70. While that's a loss, there are some forecasts suggesting potential improvement down the line. The trailing EPS as of Q4 24 was around negative $0.87.
So still losing money per share.
Currently, yes. Joby's EPS is negative, which, to be fair, is generally expected for a company in this pre-revenue heavy development stage. But the trend and the projections in the reports you sent, that's what we really need to keep an eye on.
So it's clear they're not profitable yet. What about their overall financial position? How are they looking in terms of assets versus liabilities, what they own versus what they owe?
As of the end of 2024, their total liabilities were roughly $291 million.
Okay.
While their total equity, basically the value owned by shareholders, stood at around $912 million.
Some more equity than liability.
Much more. And a significant positive here is their cash reserves. They were quite strong at about $933 million.
That's a good chunk of change.
It is. And on top of that, they're anticipating another $500 million investment from Toyota, which is supposed to come in 2 installments of $250 million each.
That level of cash on hand sounds really vital given the losses they're reporting. What about their debt situation? Are they loaded up with debt?
Actually, no. Their debt-to-equity ratio is notably low at 0.03.
Very low.
This ratio tells us how much a company is financing through debt compared to equity. A low number like this suggests they're being relatively conservative with debt financing, which, can be seen as a positive sign in a potentially unstable market.
But burning through that cash is still a concern, isn't it? They have pretty significant operational costs.
Absolutely. They're experiencing negative free cash flow, meaning they're spending more cash than they're bringing in, mostly due to those substantial operational expenses.
How bad is the burn?
Their cash burn rate has exceeded $450 million in recent fiscal years.
Wow.
Which is definitely something investors will be watching very, very closely. With that level of spending, the runway provided by their current cash and that incoming Toyota money becomes really key for their ability to reach profitability before needing, even more funding.
And how effectively are they using the money invested by their shareholders? The report mentions their return on equity, or ROE.
Their ROE is currently negative at negative 29.09%, which is below what we typically see as industry benchmarks.
Okay, what does that mean practically?
Return on equity measures how much profit a company generates with the money shareholders have invested. A negative figure here means that right now, they aren't generating profits effectively from shareholders' investments. In fact, it's showing a loss.
But is that unusual for this kind of company?
It's fairly common for a growth-focused company that's investing super heavily in R&D and scaling operations, but it is a metric investors will want to see improve dramatically as they mature.
Let's try and distill this down a bit. Based on everything we have, what'd you say are Joby's main strengths right now? What's working for them?
Well, one of their most significant strengths appears to be their leading position in the FAA certification process, at least among U.S. eVTOL developers. Getting those regulatory approvals is a massive hurdle in this industry, and they seem to be ahead of many competitors on that front.
That's key.
And secondly, their strong financial backing. Having raised over $1 billion recently gives them a substantial amount of capital to keep developing and push towards commercialization. That Toyota investment in particular signals a pretty strong vote of confidence.
And on the flip side, what are the biggest red flags? What should potential investors really be paying attention to?
The significant operating losses are definitely a primary concern. Without a clear and relatively near-term path to generating substantial revenue, the question of when and if they'll achieve long-term profitability, well, it remains a big uncertainty.
Okay.
Furthermore, their reliance on external funding sources does introduce a level of risk. If market conditions were to change unexpectedly, securing more investment on favorable terms might become much more challenging.
So the market's taking all of this into account. What's the general feeling or sentiment surrounding Joby right now? What are people saying?
Analyst ratings generally lean positive. The consensus rating is actually a strong buy. And the price targets for the next year range quite a bit, from $6 up to $11.50. This suggests analysts see potential for the stock to increase in value, but it's important to remember these are just projections, right? They come with inherent uncertainties.
Of course. What about, social media or investor forums?
Social media sentiment seems to be more of a mixed bag. You see a lot of excitement around the cool technology and the potential of their partnerships, but there's also a fair amount of skepticism about how quickly Joby can actually overcome the financial hurdles and become profitable.
Makes sense. How does Joby compare to some of its main competitors in the eVTOL space? We have some info here on Archer and Lilium.
When we compare them to companies like Archer Aviation and Lilium, Joby appears to hold a leading position, at least in terms of market presence and perceived progress.
Okay.
A key differentiator that keeps coming up is their advancement in that FAA certification process. Financially, Joby seems to be in a relatively stronger position regarding cash reserves, that $933 million plus the Toyota money we discussed.
Right, whereas the others...
Well, Archer apparently recently filed for insolvency, and Lilium has reportedly been facing some financial headwinds itself.
Gotcha. Are there technical differences too?
Beyond the financials and the analysis you sent, one difference highlighted is Joby's approach to battery tech and aircraft design. Some analysts think this gives them an edge in range and efficiency compared to Archer's more conventional approach, or Lilium's reliance on ducted fans.
I see.
So yeah, Joby's established partnerships and their current stage and regulatory approvals seem to give them a competitive edge right now.
Looking ahead then, what are some of the crucial upcoming events or potential risks that could really impact Joby's trajectory?
Key upcoming milestones definitely include the anticipated Type Inspection Authorization, or TIA, flight testing. That's expected within the next year.
And that's a big deal for the FAA process.
Oh, huge. It's a very significant step where the FAA will be closely examining their aircraft in flight. Getting through that successfully would be major.
Okay, and risks.
Well, there are definitely risks on the horizon. Potential changes in regulations could always lead to delays in their certification timeline or maybe increase the costs involved.
Regulatory hurdles.
Always. And additionally, just broader economic conditions and overall market sentiment towards growth stocks can be volatile. That could impact investor confidence in the whole eVTOL sector, not just Joby.
The recent development section also highlights some interesting moves by Joby, new partnerships, investments. Can you tell us a bit more about those?
Certainly. Joby has reported considerable progress in their certification journey. They've now completed stage 4 out of 5 stages in the process.
Getting close.
Getting closer. They've also delivered a second prototype aircraft to the U.S. Air Force, which indicates progress on their government contracts too. And they're aiming to begin carrying their first paying passengers in late 2025 or maybe early 2026.
That's the big target.
That's the target. Notably, they also announced a partnership with Virgin Atlantic back on March 16, 2025. The goal there is launching air taxi services in the UK, potentially connecting major airports like Heathrow and Manchester.
Interesting expansion.
And, as we touched on, they secured that substantial $500 million investment from Toyota, coming in two $250 million tranches, which really bolsters their financial position.
Given that they aren't profitable yet, how should we even think about valuing a company like Joby? What metrics are actually relevant here?
Traditional metrics like the price to earnings or PE ratio aren't really useful at this stage, obviously, since they have negative earnings.
Right.
So instead, investors often look at metrics like the price to book ratio. For Joby, that currently stands at approximately 3.87.
And what does that tell us?
It basically compares the company's market value to the value of its assets on its balance sheet, its book value. A ratio above 1 can suggest investors are willing to pay a premium for the company's potential future growth.
But it could also mean...
It could also indicate potential overvaluation if the company doesn't actually meet those high growth expectations. It's a balancing act. It's also worth noting they aren't paying any dividends currently.
Which is expected for this kind of company.
Pretty typical for growth-oriented companies reinvesting everything back into the business.
And what are the major risks that could negatively impact their valuation as we look ahead? What keeps you up at night if you're an investor?
Well, that high cash burn rate is definitely a significant risk. It could necessitate further fundraising down the road, potentially diluting existing shareholders' stakes.
Right.
Any delays in the FAA certification process could push back their commercial launch date, which could really erode investor confidence and hit their valuation.
Makes sense.
And of course, there are just inherent operational risks involved in scaling up manufacturing for a completely novel aircraft and then ensuring its long-term safety and reliability in commercial service. That's a huge challenge.
Absolutely. So finally, bringing everything together, what's the overall recommendation from the analysts we saw, and what's your sort of summary assessment of Joby as a potential investment right now for someone listening?
As we mentioned, the consensus analyst rating is a strong buy. and those price targets suggest potential upside. Based on the information we've looked at, Joby does present itself as a potential buy, but specifically for investors who are comfortable with the pretty significant risks associated with early-stage tech companies.
High risk, potential high reward territory.
Exactly. Their innovative technology, the progress they've made in a very complex regulatory landscape, and their strategic partnerships, those are all compelling factors. However, and this is a big however, it's absolutely crucial for investors to be fully aware of the ongoing substantial operating losses.
Can't ignore those.
Cannot ignore those. And investors need to closely monitor their progress on key milestones, particularly related to achieving that final FAA certification and the successful start of commercial flight operations.
So as we've explored, Joby Aviation is in a truly fascinating, maybe pivotal position within this emerging eVTOL industry. You can definitely see the considerable potential in their technology and the partnerships they've built, especially with the progress on FAA certification and those recent investments.
However, the financial figures clearly highlight the substantial challenges involved in bringing a completely new type of transportation to market and actually making it profitable.
Right.
And the contrast between the generally optimistic analyst sentiment and the more cautious, sometimes skeptical views you see elsewhere really underscores the inherently speculative nature of an investment like this right now.
We really hope this detailed breakdown has given you a much clearer understanding of the key aspects to consider as you evaluate Joby Aviation. Remember, it's essential to do your own thorough research and definitely keep a close watch on those critical upcoming milestones, like the TIA flight testing and any further regulatory news.
Thank you for joining us today for this look into Joby Aviation. If you found this analysis helpful, please do subscribe to the podcast, give us a like, and maybe leave a comment. We'd really appreciate hearing your thoughts and what other companies or sectors you might like us to explore in future discussions.